G'day guys, it's Jake here. Nothing in this video is financial advice. Please do your own research when it comes to investing. Alright, let's go. So, the first thing I want to talk about in this video is the Fed and what they said in last night's testimony to Congress, talking about, and also the Banking Committee, talking about their plans going forward with interest rates, the labour market, and inflation. But yeah, seeing what the numbers and data is what's suggesting to them when they look to pivot. So Jesse Cohen has done a tweet, a good sort of summary of the testimony. So it saves you time watching the whole event, which went for like 2 hours or so. So very, very long. I couldn't watch it because I just didn't have time during the day. I was been working, but I'll give you the summary here. So, summary of Chair Powell's prepared testimony. Powell signalled that the Fed is no rush to cut rates. Number 2, Powell said no policymakers remain attentive to the risks that inflation poses and don't want to ease up too soon and too much. Number 3, Powell added that easing too little, too late could undoubtedly weaken the economy. Number 4, Powell noted again that more good data is needed to boost the confidence that inflation is moving sustainably toward 2%. Powell mentioned that the labour market is still strong and the economy is expanding at a solid pace. What you want to hear. Good news, good news, good news. And just part 2 of the thread there. Powell's comments reinforce the view that the Fed is not yet ready to start easing monetary policy and the September rate cut might be too soon. So take it as you will. Definitely, while reading that, it doesn't look like the Fed is ready to cut this month, which is coming at right at the end, is the interest rate decision. And going into September, which is midway through, whether they cut then, it's still on the cards, but we'll see. The Fed is pretty, it's sort of hard to predict their moves because you go on something like a CME Fed Watch tool, and you find that even their projections for interest rate cuts aren't necessarily accurate. Like they chop and change, predictions numbers change frequently as different news comes out and data and the economy, and they just flip flop their views. So the probabilities of the rate cut this month are 5%, and then in September a 70% chance. So are they really going to cut? Look at probabilities. I don't think so. But and then you go down to November, and then December. So, definitely it's seeing 2 cuts by December, so 2 cuts by the end of the year. I don't think so. I think probably none at this stage, but it could come, and they've got to see weak data first. And I think the job market was really tell if they're going to cut or not. So, that's that one. So that's about the Fed. So looking at GDP growth, the capacity ladder, the estimates are plummeting. The most recent Atlanta Fed estimate for real US GDP quarterly growth in Q2 2024 is down to 1.7%. This estimate is down from 4.2% seen in mid-May and from 2.2% seen on June 28th. If this estimate turns out to be correct, it will be the second consecutive quarter of GDP growth below 2% after Q1 2024 GDP of 1.4%. Is the US economy slowing? So, the consensus and blue chip versus the Atlanta Fed estimate. It's from their data. It doesn't look very, very, very promising. and we could get negative GDP growth, which really attend every time a recession happens. The economy generally has a 6 months, which is 2 quarters of negative GDP growth, which really indicate they're in a recession. And we did have, the only exception was 2022, at the end of that year, when we had that big correction. We had 2 negative quarters in 2022, and they said, no, it wasn't a recession because the job market was still strong. So, yeah, it's really, really telling. You've got to have all these factors add up to indicate a recession. All right, Global Markets Investor, US bankruptcies hit the highest level in 14 years. There have been 346 bankruptcy filings in the US to date, the most since 2010. Shockingly, in June alone, there were 75 bankruptcies, higher than every single month during the COVID crisis. Hard landing is now a base case. So as you can see there, US bankruptcy filings per year, 346, which goes back to 2010, which were the last time we saw that number, and it was 467 by the half of that year. So this is the first half, and then the second half is in orange. Okay, so blue's first half to June, and then orange is the second half of the year. So yeah, waiting for the orange data, and then we've got US bankruptcy filings per month, and we're at, for June 2024, the highest monthly reading since the month of July in 2020. So yeah, very, very telling times that we're in, and you've got to piece these things together to get an understanding of where we're heading. You can't just look at one point of view. You've got to look at several different data points and give you an understanding. Prepare yourself for the next downturn, which is inevitably going to happen. All right, let's talk about shipping rates, and we'll sort of pivot now, talking about inflation, because the numbers are coming out Thursday night. So talk about that. And Michael J. Kramer mentioned the other day, shipping rates are surging, yet no goods inflation. 7 to 8 month lag is coming. Okay, so we have the yellow is the inflation rate, CPI in the US. Then we have orange, white, and blue, Shanghai to New York, and we've got Shanghai to Los Angeles, and then a composite container freight benchmark. So they all track each other, and then they're rising as inflation stays flat. So is this a leading indicator of spike up in inflation? Because you can look back to 2014, 10 years ago, and you can see that shipping rates declined, so did inflation. Inflation spiked up. Shipping rates really didn't do anything, they sort of stayed flat, and then inflation rose a bit more, and then shipping rates started to catch up a little bit, and then they declined, they both went down, and then they went sideways, really didn't do anything. There's a lag there, shipping rates went up after inflation went down, and then ultimately shipping rates resolved the downside, and we had flat reading going into 2020 when they all went up, okay, 2021. And then shipping rates fell first, and what happened? Inflation followed. So interesting. So will this lead the inflation numbers? We'll have to wait and see about that one. And we'll go on the charts and talk about, firstly, copper and how it could be signaling inflation coming up. And we'll just jump to the weekly, and what we'll do is we'll add on the inflation rate, and we'll go back to 2008 or so. Yep, 2008, and drawing tool. So we had copper going down. All right, inflation was still high, and then ultimately resolved to the downside. And then copper started to pick back up while inflation was going down. And then inflation sort of went, it's copper's taken off. Economy must be strong, and it's rising like there's no tomorrow. So it went up, and so did inflation. Right, it just shot up really steeply there. Had a correction, so did inflation. Inflation stayed flat here. Okay, so it's like, as copper was going up, inflation wasn't doing anything. What happened? Inflation caught up to copper. Aha! So it led the charge, okay? And then we had a down period. All right, and ultimately we broke even lower. All right, so we went there, and then we broke the support, went straight down. What did inflation do? Whoops, and it caught up. And then ultimately, they both trended down for quite a while, okay? And then we had inflation coming back up, while copper was sort of going down a bit. And then it traded sideways, and then they both went up, okay? As you can see there, 2017, 18. And then copper shot right down. Inflation was sort of high there, at 2.7%, 2.9%, and then it caught up to copper. It led the charge again, and then they both sort of went down, sort of sideways, and then going into the pandemic, they both flushed all the way down, going back to all the way back to here, 2015 levels, even earlier, so 2015, yep. And then copper started to shoot up, inflation caught up a bit, and then they both went up. And copper sort of traded sideways as inflation was still going. And then ultimately, what happens? Guess what? Copper broke down to here. It was sort of surging to the downside, and then inflation peaked right there, right? And then it went down, followed copper. It went all the way down. And then copper sort of started to diverge and went back up. And then we sort of corrected again to follow in line with inflation. So we diverged here, went down again, and now it went sideways here. Copper did. So was inflation, and then guess what? Copper's breaking up. Will it signal that inflation hasn't gone away and is sticky, and the Fed, they're sort of comfortable that it's on the trajectory of going towards 2% over time, but it'll take a lot longer than they expected, I think, because it's copper signaling that, inflation's very, very sticky and a very big problem. So that's copper. We'll go to oil, and oil is very, very similar. I'll bring up the inflation rate against oil to give you an understanding of it as well. And we'll go back to 2008 as well, okay? So oil broke down pretty aggressively. Inflation went slowly down. Oil was just rapidly declining, and then inflation caught up. As we capitulated down here, and inflation went down, okay? So you can see that they're correlated there. Oil started to take off, and inflation was still going down. And oil was continuing its uptrend, and inflation took up. So caught up to oil. Oil traded sideways, so did inflation, pretty correlated there. And then oil started to break up pretty aggressively. Inflation was going sideways, and then it caught up to oil. Oil went down pretty aggressively down here, so they sort of decorrelated there. Inflation was like, ooh, okay, and then it started to decline. It declined here, so it stopped here with oil. Oil is going up, inflation was going down, so there was a bit of decorrelation, and then ultimately oil went back down, and inflation went back down, so they both got back in line. And then we had the oil spike up, inflation followed oil spiked up again. Inflation went up a little bit, and then traded sideways, and then went sort of down a little bit here. So that inflation, and then oil shot up. Inflation shot up, and then inflation dropped first. Oil followed, and sort of sideways, nothing much in the scheme of things. Pretty small movements there. So trending up. This inflation was sort of trending up slightly, barely, and then 2014, big drop, big capitulation, drop. And then, it was really a bottoming process, but you had oil going down, and then inflation sort of traded sideways, and then it shot up. So it decoupled there, correlation, and then oil caught up again. As inflation sort of stayed flat, and then inflation took up as oil was sort of creeping up slowly. It corrected, inflation corrected. They both shot up here, as you can see. 2018, they both went down. Oil led the charge up. Okay, and then inflation went up sideways and then slightly up, same as inflation. And then before this pandemic crash, you had oil starting to break down below its support line there, okay? Broke, and then inflation caught up and they both went down. They both trended pretty similar there, going to this part, all the way up to the top. Very similar movements. And then 2022, we had disinflation, slightly deflation, as you want to call it, and they both went down. But oil sort of led the charge here. Oil's declining slightly, and then, not much, but, they both went down ultimately. Now we're sort of seeing sideways action for oil and inflation. This triangle I've drawn is sort of consolidation area. It's sort of tightening up the range. And then will this sort of come down as inflation ticks down, or will this break out and then inflation potentially could read higher than expected? Have to wait and see, because they have times of decorrelation, so it's not exact, but generally the overall trend, the macro, the long term, follows very similar, just like copper does. So I showed you those two. And on to the last one. So lastly, we'll talk about the US M2, which is the money supply. And we can see that it's declined, right, with deflation that we had. And as inflation sort of come down to the monetary supply, it's been a steady uptick, It just goes up and up and up as they print more money and it goes into the economy. And that's just what it's like. It just goes up and up and up. And having an uptick here. So will this continue aggressively or slowly? Will it dictate? Because we always have inflation. Inflation will always be there, okay? And whether it's a small amount, a big amount, during the pandemic and that, we had a huge vertical at the end of 2021. This move was just absolutely incredible. Like the amount that they sort of printed, like the vertical, the vertical slope compared to something like 2008 to that period was very slow. This one here, boom, shot right up. So had a lot of inflation recently. So very sticky because it's sort of digesting this move. So we'll see what happens there with the US monetary supply. It's a interesting indicator, looking at inflation as well. So yeah. All right, guys, I hope you enjoyed that video. Looking over the charts for leading indicators for inflation, and also looking at the Fed, what they had to say in the testimony, seeing they're getting things under control. But I hope you enjoyed the video. Please smash the like, comment your thoughts below, subscribe to stay updated, and I'll catch you in the next one. Cheers.